Vanakkam, Namaskar, and hello to all the viewers and listeners of this edition of Fixed Income Market with Sundaram Mutual Fund. Wishing all our viewers and listeners a very happy FY24. Shubham Bhavetu. In this episode, a prelude to the monetary policy on 6th April, we discuss the macro setup both local and global to try to ascertain the MPC decision. More than the decision, the markets are eager to understand when would the monetary policy committee be done with hiking rates, as we are already at 6.5 and inflation is likely to come up in the coming months towards 5% mark and growth pangs have started to show up. Immediate worry is the prices of food articles like cereals, milk, sugar, spices, etc., which are robust and any failure in monsoon could worsen the situation, particularly El Nino in the backdrop. Energy prices have been flat as the consumers have not paid market prices to benefit from the downward move in the international crude prices on tax considerations. India inflation is gravitated towards food and fuel. Any negative surprise on either can cause the inflation outlook to worsen. On the twin deficits front, the fiscal deficit continues to be high despite the government's endeavor to consolidate, and heavy supply in light of decent credit offtake can push up the yields on the government securities in an adverse scenario. The supply of government securities this fiscal is higher than the last fiscal in absolute terms, although fiscal deficit as a percentage of GDP is lower at 5.9% versus 6.4%. On the global front, although inflation has started cooling off, it's still miles away from the target. This has kept the Federal Reserve and other developed market central banks to keep the leash on liquidity and keep hiking rates. This is despite the turmoil in the banking sector and commercial real estate looking vulnerable. We believe that MPC will hike the repo rate by 25 basis points or lesser to use the space created on account of upward surprises in domestic inflation trends on the last two occasions, and price pressure still prominent can be best neutral on rates going forward and uncertainty or monsoon and food prices continue. The global backdrop also calls for raising the rates as a lower rate can cause real return in India to taper off, causing the pain through the currency channel. Last but not the least, with taxation parity, mutual funds might become more attractive on the shorter end of the curve and incrementally medium term money, which is 3 year plus kind of money, could find alternative pastures depending on the risk appetite of an investor. From most conservative moving to safety of large bank deposits, while some others could move to alternate funds with higher risk characteristic, but most of them would try to get compensated for tax loss by higher yields with minimal incremental risk compared to mutual fund platform. In general, we believe mutual fund being a pass-through product and basis apple-to-apple comparison, they remain attractive for fixed income investor in spite of the LTCG benefit being withdrawn. On the product side, we continue to recommend adding duration for investors with 18 to 24-month horizon, but not very long bonds as the incremental return does not compensate for the illiquidity in long to very long duration bonds. For most investors, mid-duration strategy works better. Investors should continue to use the cash management products in form of overnight and liquid funds depending on their tenor of investments. Thanks for joining us in this episode. Looking forward to see you in the next episode.